My name is DuBose. I am an associate at Cetane Associates. I work on the finance team, which is really the boots and the boots on the ground, preparing the financials and getting the decks together for the SIM in our process, in the Cetane process. I Prior to joining Cetane, I worked in commercial real estate valuation for the first 5 years of my career, and so hopefully I can bring some of that expert knowledge and expertise to your deal.
Yeah, thanks, Ford. And hi, everyone. I'm Trey Brasseaux. I'm a vice president with Cetane Associates, and like Ford mentioned, we work on the aptly named finance team at the firm. So our main role is to really support our transactions from an analytical and information perspective to help buyers get all the information they need when inquiring or considering purchasing the businesses of our clients. So yeah, again, thank you for joining us today about real estate in an M&A transaction. We're going to talk through some dynamics there, how it works, is it included or not, how it kind of impacts valuation, and ways that you can sort of get ahead or things to consider about a property, whether buying or selling a business. So we're going to go through a couple slides here. Should take 15-20 minutes, and then we'll take kind of the balance of the time to discuss questions that have been submitted or anything that people want to ask kind of throughout the webinar. So with that, let me share my screen real quick. So yep, again, so kind of three concepts here with some themes kind of within each of the three. So kind of to kick us off, the first kind of question is, real estate, is it included in an M&A deal? If you're buying or you're selling, how should we think about the real estate? Is it typically expected for the property and the facility to be included with the business when selling or buying a business? The headline or the quick answer is it varies and it depends, particularly around preferences, ownership, and the nature of the property. So again, to step through our kind of themes here. So the largest driver of whether the property or the real estate's included in a business transaction is what are the preferences of the buyer or the seller. So most often we typically see that the seller's preference drives whether the property is included or not. So at Cetane, and usually when we see other deals as well, the business is positioned to treat the real estate based on how the seller wants to treat the property, whether that's buying it or selling it or leasing it to the potential buyer. So that's usually the most common or most important driver, and it's typically respected by the buyers in the marketplace of treating the property like the seller desires. But that may also cause potential buyers to sort of fall out of the process. So it depends, right? If a buyer really wants the property and the seller wants to keep it, that buyer just may not be, the right buyer for the business. So it can potentially weed out buyers. Now, again, the seller preference is important, but the buyer preference is also considered and is also important, right? This is a deal that two parties are making, and we got to come to an agreement. So the buyer's preference is certainly important as well. And what we typically see is that it depends on kind of the industry and the buyer's, typical investment strategy. So what does that mean? On the fuel oil and the propane side, we see buyers there's some who have a strong desire to own properties, particularly around the storage assets. And then there's other buyers who are strictly a no real estate holding type of a strategy where they almost always lease properties. So it does depend on the pest control and landscaping side. We do see leasing happening more often than not. It's largely due to kind of the tuck-in nature of those transactions. They're easy to fold into the buyer's business. And then also, there's just not as large of a physical footprint kind of necessary to operate those businesses. So we don't see a lot of real estate purchases in those transactions compared to the fuel oil and the propane side, where there is buyers who certainly want to own those assets. So again, what do the buyer and the seller want to do? Number two is who owns the property. So who owns the property certainly will dictate how it's treated, or at least how it's presented in a process, in a sales process. So if it's company owned, the base case is that that property is going to be sold with the business. That doesn't mean it can't be carved out of the deal. It's just that's usually the kind of the baseline expectation. That's because that's a company owned asset that is used to generate the cash flows of the business. So usually it would be expected, at least at first, to be included, but that's not necessarily the end all be all. If it's a related party, and you're going to hear that term throughout this presentation, what related party means is, an LLC usually where the owners of the business have own a separate LLC that owns the physical real estate property. So that's a related party. We kind of think that is quasi company owned. But if it's a related party, there's not necessarily an expectation that it should be included. It's held separately for a reason. So it really does provide some flexibility there, and it's quite easy to either exclude it or include that property in a transaction. So no expectation really there around a related party ownership. Then obviously, if it's a third party property, the business or the owners do not own that property. The conversation really becomes around the lease. Is it transferable, and kind of getting the landlord involved in order to make sure that the buyer, if they want to continue leasing that property, how can we essentially get that lease transferred over or get something sort of set in stone via a new lease with the buyer? So who owns the property? Then lastly, it's what is the nature of the property?
Yeah, thanks, Trey, for those first two topics. I can handle this last one. So, what is the nature of the property? This means a lot of things. First of all, what's the property's use? Kind of where does it fit within your organization? Is it a key cog that keeps the business running, or is it more of a additional office that's more of a convenience to employees or a slight optimization to one part of your business? Also thinking about strategically is the buyer going to want this property? Is it in an area that's around customers with regards to storage or office? Or is it more of a area that's in transition that maybe development is changing around and it's not necessarily a great place for that business to be, whether it's drivers coming in and out of a office on a busy thoroughfare, or just the value of the property increasing above and beyond what it's currently being used for. And that kind of gets into the last bullet here about highest and best use for the property. And we'll cover that more later on in the presentation.
Yeah, thank you, Ford. So again, question one, is the real estate in the deal or not? And the highlight there is it depends on preferences, ownership, and what the nature of the property is and the value of it to a potential buyer, and what the seller's perceived value of the property is. So kind of concept or question two is like, okay, we talked about is it included or not? What drives that? How does including it or excluding it impact the deal or the economics or the proceeds? What does that mean for the kind of overall dollars that we're talking about in a transaction? So the theme here, that what you want to kind of keep in mind is the overarching kind of guideline is when selling a business or buying a business, the cash flow that is being presented should reflect what a buyer is going to generate, right? Like what cash flow is the buyer purchasing and what is their cash flow expected to be? So that should reflect the property, and any rent expense that's related to that property. So basically, high level, if you sell the property or include the property or the real estate with the business, it increases your cash flow and your purchase price. That's because you don't have any rent expense in there in your EBITDA, and then obviously you have more assets being contributed to the business, so overall increased value. So to kind of step through again these three concepts within this, going back to our first one, is it included in the deal? If it is included in the deal, you're selling the real estate, then there would be no rent expense in your cash flow. No rent expense, in theory, that should be a higher EBITDA, which we almost always see these businesses in this market being sold on a multiple of EBITDA, so no rent expense would mean there is a higher EBITDA and an increased purchase price. If you're retaining or not selling the property, there would be rent expense included in your EBITDA. So your EBITDA in theory would be lower by the rent expense for the property. Again, this is about presenting the cash flow on basically in the buyer's perspective or on the buyer's basis. If the buyer is going to be leasing the property, then the cash flow presented should be burdened by that rent expense, and vice versa if the property is coming along or being sold with the business. Um, Real quick on the, retaining the real estate, it provides some kind of different, benefits, if you will. You can kind of separate some of the real estate liabilities or issues around it, kind of quicker diligence, not as much environmental things like that. So it'll often allows for a quicker close, all things being equal. Number two here is okay. So we've talked about how we need to include or exclude rent. What rent is that? Is it market rate? So this is a topic we often are discussing with our clients, and we see in the marketplace is the company paying market rent? Most often, when a business, the owners of a business own the property in another company, a related party, and the company pays the owner's LLC rent, it's almost always not market rate. So that's something that we're always talking about and evaluating what is the market rate rent, because that is what essentially a buyer is going to be expecting to pay if they're leasing that property. A buyer is going to be paying market rent. You very rarely is they're going to be some sort of sweetheart deal where a seller is going to be charging a buyer rent that the seller would pay itself. They're probably going to charge them what they would be getting in the marketplace. So that's kind of the second question you need to ask after if you're including it or not in the deal is what is the market rate of rent there. So you need to understand that because that's going to be a driver of the cash flow, and it's going to be a driver of any potential lease that's going to be set up with the buyer upon closing. Then lastly, we just see triple net lease is the most common. So you'd have a market rate rent for kind of the base rental for renting the space, and then you would add in all your related property costs there to get to your triple net lease. And we'll talk a little bit about the expenses on that on our next slide. Lastly, here, just to walk you through a couple examples of kind of how this works, selling, retaining the property, how it impacts your cash flow. So first here, if the real estate is sold, so it's included in the transaction. If the company owns the property itself, going back to our first slide, expectation baseline is that it would be sold, property would be sold with the business. The company pays no rent, and so there's no change in EBITDA. The cash flow that you kind of come up with is not impacted by any rent there because you're selling the property and you're not paying yourself any rent. So the buyer would not basically be incurring any more additional rent expense if they purchase the business with the property. Secondly, is the company owns the property via a related party. The business pays the related party that rent. You would add back that rent expense to your adjusted EBITDA. So you would increase your EBITDA for that rent expense because your P&L, your EBITDA is currently being burdened by it on the sell side, I should say. And you want to present your cash flow with that rent expense being excluded because a buyer is not going to have that rent as the property is coming. So increase EBITDA, increase transaction value. If the real estate is not sold or the real estate's retained by the business owners or the company, couple similar concept here, but a little bit more nuanced. So here you really got to think about the market rate of the rent because the seller is going to be charging rent to the buyer. So if the company owns the property and pays no rent, similar as the bullet one under the first example, you would reduce your EBITDA by the full market rent. So you're not paying yourself any rent. A buyer will be paying rent for that property. Your cash flow has no rent in it. You need to basically add the additional full market rate of rent there. So that would reduce your EBITDA, reduce your value. If the company owns the property in a related party and pays the owners of the property, aka the business owners, rent, you would reduce the adjusted EBITDA by the difference between the rent being paid and the market rent. So we would call that a market rent adjustment, because, like we said, the companies rarely pay full market rate to the business owners in a related party. So, but since you have some rent expense being burdening your EBITDA, you don't adjust for the full market rate amount. You just adjust it to get to the market rate. Again, the theme of representing the cash flow that the buyer should expect to generate post close. Then lastly, on kind of retaining the real estate, the property owner would obviously not pay any taxes upon the sale of the business there. So you kind of defer any of those capital gains taxes on the property to later when you decide to sell it, and you receive that rental income over time. And then, of course, you keep kind of an option. The seller would keep an option, to sell that property at a later date. Really quick, we do often see that buyers will kind of put in a right of first refusal on the property. That's makes the buyers often feel a little bit better about the property won't be sold out from underneath them at the end of a 5-year term. Just wanted to include that little note there. So again, how does including or excluding the property impact the overall value of the transaction? You got to keep in mind, what is the cash flow that you're presenting, and how does it increase or decrease the cash flow and therefore the value?
Excellent. Thanks for that information, Trey. It's very insightful. The next phase of this presentation that I'm going to go in is kind of what else to consider when you're preparing to sell your property. It's very important to know your property, its history, and your future vision for how you envision the real estate being treated within a transaction. So bullet number one, and we kind of touched on it on the very first slide, but value and highest and best use. And I know that we've expounded on this, but it's very important to know the market value or rents going into a transaction. It's setting the target for what buyers can expect to pay or rent a property for, and it makes you comfortable knowing that you're getting a fair deal on the real estate included within the business. Ways you can prepare for this. You can consider obtaining an appraisal. Appraisals run several $1,000s and can be a little bit of an expensive option depending on your business and your organization and the cash flow. Another option you can get is a broker price opinion. So that is going to a real estate professional within your community. And we strongly suggest that you seek out a real estate professional, a real estate broker that specializes in your property type. So if you're a propane and heating oil business that is in an industrial area, it's very important that you get a broker that has done deals within that property space and knows your market. And same thing if you have a property that's more in a retail or like commercial area, it's great to know the price going into that by using a broker that's very specialized in that area and in your property type. This is typically performed by buyers in diligence, but it's helpful for us to have an advanced expectation. And this all goes back to what is the property's highest and best use? A lot of the businesses that we see have been around for decades, and if not centuries. And so, as we all know, real estate shifts with the wind. And so, a great way to determine whether it would be a good idea to get an appraisal or a BPO is think about your commute to work. Are you sitting in traffic for 30 minutes? And when you arrive at the office, is there a Starbucks next door? Is there a Walmart down the street? If that's the case, you're probably in a transitioning area. And it could be that the value of your property is not necessarily a office for your pest control business or your oil or propane business. It could be more advantageous to move your location and then sell that property maybe to a real estate developer or try to lease it to a retail tenant. So that's something you definitely want to get squared away before starting our process. Number two is environmental concerns. It's very important to understand the environmental history of your property. This is where things can really get held up in diligence. Sellers are typically responsible for all the environmental conditions, even ones existing prior to their ownership. So it is important Maybe your property was used as a dry cleaner, or was a fuel distribution site, and you're not really sure how the previous operator handled all of their spills. So something you should consider before going to the market, or even to prepare your business for the sale in the future, is performing a phase one environmental study. This can really help identify some concerns and allow time to evaluate steps and address it proactively, so this doesn't become a holdup in the due diligence process. It's also very important to keep all files and letters regarding environmental concerns. So that would be stuff like tank closures, spill events, remediation work, SPCC plans. It's good to have a proactive handling on this. And we always recommend, if you are have a lot of the physical copies, paper copies, to scan those and keep them somewhere on your computer readily available, because we often see that sellers, when it comes time to sell, they're scrambling around looking for this documentation. And so it's always good to have that on hand. Lastly is other important documentation. Lease agreements. I know Trey has touched on this, but if you lease your property, it's important to understand all the ins and outs of that lease agreement, as specifically related to the transferability. You want to be able to continue operating that business if you sell it. So it's important that the buyer has assurances that they're not going to have to go out and find a new property to be able to base the operation out of, because that can throw a big wrench in the machine when you're trying to transfer ownership over and transition employees. Title and deeds, it's important to know the physical location, one, and also to ensure that it's recorded properly, that it's the proper name on the deed, and that it's been filed with the local municipality, and that it's squared away, because that's another big hiccup that can happen in a deal. Surveys are commonly requested. This is something that typically you can get done along with a BPO or an appraisal, and these are great to have on hand. And once again, typically these are in paper form, so it's great if you have these things hanging around in physical form to scan them in and keep them handy, because it can just really alleviate the headaches down the road when you're trying to gather all this information. And then finally, knowing your expenses that are going specifically regarding the real estate. So that would be those triple net expenses, which are typically real estate taxes, common area maintenance, and property insurance. And so it's important to have those isolated within your operating expenses, so that a buyer knows exactly what to expect, in addition to the base rent, with regards to how much the triple net expenses are going to be. And on the flip side of that is a property improvement a capital expense? So what we're trying to say there is, did you put a new roof in? Did you put a new HVAC unit in? Was there foundation leveling? These are more of those one-time expenses that are associated with the real estate that we can add back into EBITDA and help increase the value of your business. And once again, all of this just positions you to avoid the surprises and to be in the best possible position to alleviate the headaches during the sales process, whenever that is for you.
Yeah, that's great, Ford. Appreciate that. One of the more underlooked pieces of a transaction process is this piece right here, particularly when there's a property that's been in operations for decades and has been developed for even longer. So definitely something to think about, and can be very important and help the speed and success of a transaction. So those are kind of our three kind of concepts or topics there, guys. We've got a little bit of time, so Ford and I want to take kind of 5 or 10 minutes to look through some of the questions that have been submitted. So let me get those in front of me real quick. And thank you to everyone who did submit some questions. So Ford and I were kind of just read through some of these. So first one we're going to cover is, should the business property be held by another entity and rented back to the business? So we hit on this. This is the related party real estate dynamic. I think, should this be the way it's set up? I think we would say it's nice or attractive from a tax perspective. So it allows your business to, reduce its taxable income. in a situation where if the company owned it, that would not be necessarily the case. But from a transaction perspective, at a high level and generally speaking, it doesn't make a material difference on the success or closing of a transaction. It's relatively easy to get that third party as a party to a purchase agreement, or since it's already separated, it makes it even easier to keep it sort of out of the deal. So yeah, it's good kind of from a financial strategy, but for a transaction, it provides some flexibility, but it's not a hang up or doesn't make it easier or less easy necessarily to do a deal.
Excellent, Trey. Yeah, great answer there. I got the next question here is, do most buyers want to purchase the real estate or lease the real estate? And I guess the answer there is it really depends. In general, buyer preferences vary on the strategy. There's definitely the buyers that want to be a propane company or a pest control company and not a property management company. In my experience, typically those buyers tend to be more on the financial private equity side. And so they would prefer to lease the business and just lease the real estate and just focus on operating the business. But it really depends. On the fuel side, we definitely see purchase is typically the preference, especially when it comes to kind of the storage and fuel assets. Buyers typically like to keep that in control and know what's going on there, and have it secured within their ownership where they're not worrying about, oh, are they gonna renew the lease, those sorts of things. But once again, it varies dramatically, and also depends on the geographic location of the buyer. If they're coming into your market and this is going to be their first flag in the ground there, typically they'll like to own the business, or own the real estate.
Yeah, that's exactly right, Ford. And I may even just tack on adding to the variability of it is it can change throughout a transaction too. It can change from an offer that is inclusive of the real estate, and then you get into diligence, and then now the buyer doesn't want to purchase the real estate. So it even varies on a diligence and kind of deal by deal basis as well. Next one here is, can you sell the business and lease the real estate if the real estate was used as a depreciation of the business? Yeah, you can. Quick answer is yes. Just because the company took depreciation expense on the property does not mean that you can't keep the property. What what the depreciation does is it essentially just, if you were to sell it, impacts your basis there when you go to sell, and then would bring in potentially some depreciation recapture when you do eventually go to sell. But yeah, you could just keep the property, lease it to a buyer, and you would just keep depreciating it kind of as scheduled.
Excellent. And the next question we have here is, we often will include real estate outside of an acquisition since it involves external diligence. Should a property be sold with the business or as a separate transaction? Um, so we think that excluding the real estate from the transaction typically makes the diligence process much quicker and easier because you're avoiding most of the environmental due diligence that's required there and all of the title transfer surveys, things of that nature. And we have seen real estate be closed separately from the business, going back to owning the business with a third party. It does make it much easier to transfer the business ownership and then the real estate ownership at a later date, just because real estate can take a longer time within the whole diligence process because of all of the environmental title survey work that needs to be done. Also, by selling it separately, you can, like we said, move quicker getting the business sold, and focus on that transition. And it can typically be covered with contingencies within a purchase agreement as far as closing on the real estate.
Yeah, absolutely. So should it be? It really depends, of course, but it does provide a little bit of flexibility by keeping it separate, and we've seen it the closing process where a real estate transaction, the real estate piece will close after, the business because it keeps the business deal kind of moving forward without the extra kind of property considerations. Um, Next one here, how does the real estate impact both the valuation and the downside risk of the deal? So, and I think this hits on a couple of the questions that were submitted in the chat just now too. So I'm going to hit on those. But we talked about generally including the real estate's going to increase the transaction value. Additional assets there that can create some goodwill or intangible value to a buyer. And then, the most basic idea of that is that your cash flow will not be burdened by rent. So you're generating more cash flow for the business just based on that rent expense alone. Um, so that's how it would increase the valuation. Downside risk, again, going back to what Ford was talking about on knowing your property, a lot of times things are uncovered in that diligence process. That's kind of the point of it. And so the sellers often learn a lot about their property, maybe not even in a good way during the diligence process. And so by sort of keeping it in the deal, the seller may have to make additional representations or warranties, may have to put more escrow funds out there to kind of cover that liability in the event that something is going wrong. And then, by keeping it out, the property out, you can sort of avoid that because the buyer, frankly, they care, but they wouldn't be taking on any of that risk if they're just leasing the property. On the environmental, I see a chat in here, what's typically performed phase one or phase two. So yeah, the quick answer is that if a buyer is purchasing the property, there will at least be a phase one. Phase one is essentially a record search, kind of a history search that tells you there might be something wrong here and is a phase two necessary. So phase one doesn't tell you if any remediation is necessary or give you a plan. What it does is kind of raises the red flag based on records and things like that. If the phase one comes back, necessary for a phase two, then a phase two is almost always going to be performed as well, depending on the phase one, but usually it will be performed. Phase two will be performed. So when we say do environmental ahead of time, we would say consider doing a phase one to see what's potentially out there for your business. Real quick, Ford, and I'm just going through some of these that were live here. Do you value the real estate based on the market rent and how it affects EBITDA? So the way we think about this is the market rate rent and the value of the property kind of go together. And Ford, you can chime in if you'd like, but high level, it also says what multiple of EBITDA do you use? So we typically say that a property generally trades at like 10 times its market rent in the marketplace. So if you kind of know the fair market value of the property, should know the rent and vice versa. And so that market rent would be what we're using to adjust the cash flow, or it kind of gives us a back of the envelope number to keep in our minds for what the property should be worth in the deal. So that would be my answer there. And then do they typically subtract the value of the real estate after applying a multiple, or do they factor in the value of the real estate and then apply a multiple? Yeah, so I would say that it's a little bit of both. The business is going to be valued on the multiple of EBITDA, high level. So that's going to include the property there. So kind of cut and dry value of EBITDA reflective of the real estate treatment is going to be the valuation of the business. Now, does their opinion, a buyer's opinion of the real estate potentially influence the multiple? Yes, it does. If a buyer sees that property as attractive or very accretive to operations, there may be some extra goodwill put in there because the buyer sees the value of the property as really, really incremental or accretive to the business. And then when they go into a purchase price allocation, which again, the purchase price would be based on the cash flow and the EBIT in the multiple, they go into the purchase price allocation really gets down into the dollars and cents of what they think the property's worth when they go to allocate that purchase price.
Right. And I'd get back to highest and best use with regards to the market rental rate. If the market rent is overly burdensome on a business where it doesn't make sense for that business to operate there, if it's on the corner of Main and Main, and you could be charging 30, 40, $50 a square foot, and then there's an industrial park, a mile away where you're charging $5 a square foot, that's where you can really create value with real estate being above and beyond the value of its use within the business. So that's something to be considering years in advance before a sale is my business, does it need to be located here? Would I be positioned better to transition this over to a different use and sell it at a market price and move my business to an area where I can still conduct at the same level, but be paying, a quarter of the rent? So that all comes into play there.
No, absolutely. And then you start talking about value to seller to value to buyer, and that's a lot of times what will drive the treatment of the drive the treatment of the real estate, is kind of, just perceived differences in the value. And there's a similar question there, just to tack onto this one about, how do you distinguish between a real estate asset that's part of the business versus incremental to it? And how might a bulk facility be differentiated from an office space or another kind of non-operating sort of asset? And I think Ford hit on that well. I think high level, the bulk storage assets are going to be seen as strategic and going to want to be controlled by a buyer, whether that's through a long-term lease or through purchasing the property. Those are going to be seen as key pieces of real estate property or assets that a buyer is going to want to make sure are locked down in a transaction. So that was what we would say kind of part of the business. Where business is incremental, I would say that's really where the deal making or the agreeing has to come in between a buyer and a seller, to Ford's point of main and main, right? If a buyer is looking at a business that has an office space that's in the best part of town, and the seller wants to sell the property, just to pick a number, if it's appraised at $1 million based on its location, a buyer may be like, yeah, you need an office space, but I don't think I'm willing to pay that. So it really comes down to, again, that perceived value and highest and best use. And, does it make sense for a buyer monetarily in a transaction? So that's that. I think we're about, 10 minutes over. I saw one real quick about 1031 exchanges. Has that been used? We've seen it a couple times. I worked on one where it was kind of an interesting dynamic because the company was owned by a retirement kind of account. So it was a little strange, but the seller did do a 1031 exchange, but they lived on the property. And so they were only able to do the 1031 exchange on the amount of the section of the property that was not for the primary residence. So there was like kind of two tracks on the 5 acre parcel that they had to kind of split up to do the 1031 exchange. Yeah, and then lastly, Ford, do you want to end on this normal
Yeah,
customary lease back?
absolutely. So I have this my interest in attending is purely for learning with no current intent to sell my business anytime soon. I'll be interested in learning more about the passive income concepts, normal customary leaseback details, and when a company is sold or purchased. So we're happy to talk about each of these items, and how real estate fits within your business. You can contact Cetane Associates on our website or email Trey or myself, and we'd be happy to set up a call to discuss how real estate fits within your business and get a plan together, whether you're looking to sell today or sometime in the far future. We're happy to help you get your road plan together and get a good game plan with the real estate and the overall business, and just get a gut check on kind of where you stand today.
Yep. Thank you, Ford. So again, on our website, you can go on to schedule a discovery call and your free transition planning guide. And we're always happy to discuss a free value range analysis, whether you're looking to sell your business or curious just about where you kind of stand today. Also, from the buy side, we are always happy we're always looking to meet new buyers and answer questions of what we're seeing in the marketplace. So please do not hesitate to reach out. Lastly, the webinar here will be posted at some point this week on our website, so keep an eye out for that. And to end, just wanted to say thank you everyone for your time and hope you found it informative.
Yep. Thank you, everybody.